Hey everyone, welcome back. My name's Levi. This is Drawbridge Finance. It is October 28th, and this is my Tuesday live stream. It's for everybody. It's the free one. I get to just spend some time with you talking about options, stock, long-term investing, dividend investing, all those fun things that I love to do, and I've been doing now for almost 30 years. It's crazy. I actually started investing in 1996, which is quite a long time ago now, and it has been quite fruitful for me. It has done, put myself in a position where I can live my life without having to work, that 9 to 5. That being said, I do spend a lot of time on my YouTube channel in general, and I do love interacting with you guys. So if you like my content, remember to hit that thumbs up button. It does help a ton. If you guys know anybody that may be interested in talking about the types of things that I talk about, I would love for you to share this video with those people as well. That would help my channel a ton. I've been doing this for a long time. I've been making YouTube videos for a long time, and I feel like I provide a lot of content that I would love to get out to different people, different people out there in the world. One of the things that I want to chat about today, we're going to get into this market because it is crazy, but just in general, I talk to a ton of people, and one of the things that I like to talk to people about is, maybe not being as complex as I am. I'm a rather complex trader, and it's interesting that people think that about me, but really what I do is I have a lot of long-term portfolio holdings that I just hold for the long term. And those are things that just generate money from either dividends or stock appreciation. And what I talk about consistently on the channel is options, because that's what I do week to week. And it's kind of like the hot topic. It's the stuff that I'm looking at all the time. But really the core of any type of investment strategy is looking at, not necessarily doing swing trading, not necessarily doing option trading, but looking at core holdings and saying, what if I hold a portfolio for a long period of time? I see there's a couple people online. I see Mike is online. Thanks for saying hi. Dennis is here. Justin, good afternoon. You took your first trade in 1975. That's amazing. I feel like when I was phoning it in, it felt so old school compared to what we do now, which is like on our phones and multiple apps, multiple screens. It's all things going on. But wow, congrats! You should be running a channel. You should be telling us about what we're doing. But appreciate you watching me, because that's fantastic. And Kushal is also saying hi. Thank you guys for all the support. I love it. Mike says, I wasn't alive in 1975. Neither was I, Mike. Neither was I. But everything we talk about here, not financial advice in any way, shape, or form. Just what I'm doing, what I'm looking for. Where's my disclaimer button? That's what we're doing, what we're looking at. Markets are at all-time highs, so it's kind of crazy right now. And of course, my goal with this channel is for everybody to get rich together. So let's jump into what's going on in the market and take a look at what is happening, because SPX at up 0.35% today. Oh, I just clicked off the NQE there. Let's go to the 1 day chart on these. Yeah, sure. Let's open that anyway. So let's just look at SPX up 0.35%. We can see there's just astronomical growth. It's crazy to see what is happening. Are we going to see rate cuts in the United States? Is this going to create a continued move to the upside? We're already at all-time highs. NQ looking at all-time highs. We're actually starting to break outside of that Bollinger Band, which is, to me, that every time we see this happening, when we see it peaking, I mean, it can ride it for a little while, but we often see pullbacks when this happens, and that could happen at any time. Just so everybody's aware, the market doesn't necessarily go up in a straight line, even when it is going up, and it is very, very bullish right now. One of the things that's happening is volatility index is quite low, but it's not like historically low. It's not in the 10 percentile. This is at 16. So we could see some volatility one way or the other. US oil, been a nice little play for me. I timed this bottom so perfectly. I was out with a bunch of my stock trading friends, and I talked about this. This was on Tuesday. I had put a trade on Monday. Tuesday night, I was like, this I think is the low on oil, and here we go, shot up. So that was nice. Gold, after 9 weeks of running up, we are seeing a pullback, and we're seeing that coming into the Bollinger Bands, which is nice. This is a nice little trade for myself and for my patrons, because I was sitting out of gold, and then I was waiting for a potential pullback, and I have some positions on that are right in the profit tab right now. Now, there is downside risk. You have to play risk to one side or the other when you're playing options. There's no choice. So what I've done is I've put a position that, I'm going to make some money if it stays relatively in this area, but I really don't want it to go too low, but it could, and that's the woes of trading. Sometimes they go up, sometimes they go down. Silver, I've been riding a nice little position for a while. This has been outside of the Bollinger Band, actually getting into a range where I think we might see some nice price action. So some of the stuff just working out quite well. Apple outside of its range, most of the Mag 7 stuff is. So if we look at some of these stocks, AMD obviously way up. Adobe has earnings coming up. I have a trade on right now that I really think I should get out of my trade and see what is going to transpire. I would like to see Adobe trading over 280. That is, 380. That is my profit target on Adobe. So if you guys are looking at that, that it's not much higher than where it is now with this run, but we do have earnings coming up, in when is this? This is December 11th. So a little ways away, but are we going to see some continued upside? I hope so. I would love to see it trading above the VWAP. It's been rather beaten down. Amazon, kind of in the middle of its range, looking at these positions. Now, if you guys have stocks you want me to take a look at, please just type them in the chat window on YouTube and we will take a look. I see a couple people jumping in. Justin said he had to call a stockbroker then. Yeah, of course. I mean, we all at some point in time, like I had a broker. I had somebody when I started investing. I was doing some self-directed stuff, but then I had somebody managing my money, and that was fantastic. I am not against money management in any way. I know some people are like really shy away from, where's my buttons here? Some people shy away from having managed money portfolios, but I think there is a time and place for that in everyone's portfolio, especially as it grows. I work with a couple of really great people that do different things than I do. Like, for example, I work with a company that does managed options for people, which is really awesome. And if you guys are interested in that, it does require a minimum amount of capital. But if you're interested in that, you guys can always send me an email and I can give you that information of different brokerages that I've met over the years that offer things to people that are different than the services that I offer. I also work with a really great swing trading service. So there's a whole bunch of different things, and it's a cool way to operate as a YouTuber. I get to meet tons of people. Like this week I had a meeting with a company in the US. I don't know if we're going to make an agreement or not. Those are always a bit tricky for me because if I'm going to promote their product, I usually have to use their product. And in this case, I'm not able because I'm not American. So the agreements that we enter when I'm looking at those types of things are a little bit different than when a lot of the products that I offer. If you guys are looking down in the description and you're seeing links, almost all of the links that you see in my YouTube video descriptions are products that I use, and that's why I recommend them. I don't just like willy-nilly like I'm going to promote so and so. I actually use these products week to week or day to day, depending on the time frame. So I hope that everybody understands that that's kind of how I operate. It doesn't make sense for me to promote something that I don't believe in or don't use. And believe me, my inbox is full daily of ridiculous promotions and people saying like, hey, can we pay you to promote this? And it's just like, I just don't do that. I hope that, I'm able to make enough money off of YouTube views that I can continue to run the channel and, not make it a loss leader for me. Thanks says, hey, Levi, don't forget to like and subscribe. Yeah, I appreciate that so much. Mike says, when you're ready for a question, I've been studying gap fills lately, using yesterday as an example. If you wanted to play a gap fill trade on SPX, what strategy do you use? Broken wing, butterfly, credit spread. When we talk about that, are you talking about SPX? Yeah, let's fill trade on SPX. Let's take a look at SPX. So yesterday, we do have this gap. And the question is, you can see it here actually. If you look at the volume profile that I have on this side, we can see where there are gaps, where there just was no volume trading. And basically the price action skipped over. In these cases, it's pretty hard to do it because with a broken wing butterfly, for example, we actually have to have that gap fill on a specific date. which is difficult. So I think in these terms, if I was looking for a directional trade to fill this, I would play it as some sort of credit or debit spread that is directional. So I would say, okay, here we are at this place, at this point in time. What can I do if this stock comes back down, or the SPX comes back down and fills this up? Now, if we knew the specific timing of it, if we were to say, oh, well, you know, I think it's going to happen this Friday, the 31st, which is Halloween, my favorite time of the year. If we were to try to gap fill there, it would be great to do it with a butterfly or something like that. If we think that this candle is going to be a point of support, then what I would do is I would set up trades that just make money above that. So this is where it's a great play to do, like, say, a honey trap, which is a very simplistic trade. I'll show you one here in a second. But say you've got this, we think that there's going to be support at that 68. Where are we here? 68. So I have like a love-hate with TradingView. 6804. So right at 6,800. What if we saw that there, or we thought there was going to be support there? What could we do to set that up? Well, let's look at one of the new platforms that I'm using. Speaking of working with people, let's look at Moomoo, and which I'm loving, by the way, SPX index, and we'll go to the options chain. And if we thought that was going to happen, say October 31st, is there potential of us putting in a trade? Well, the first thing I would want to do is I would want to get myself in a position where I have a break even around that level. And there's plenty of value on the weeklies still in these positions. So say we've got 67.90, I would want to buy some sort of put spread, and then the 68.10, I could sell one of those. This is going to give me a curve that has a break even close to that 6,800. And how I'm going to set that up is, right now you can see the break evens at 6,807. What I'm going to do is I'm going to sell a few of these to get some credit, and then I'm going to use credit to buy a spread that will reduce the downside. So it's pretty simple. This portion of the spread, we're just going to increase the number of contracts to 3 and 3. So I've got $20 wide spreads on this case, and the break evens at 6807, which is above that top of that candle, the wick of the candle actually. And then what I would want to do is I want to add some bear put spread below that. So, or sorry, a bear put spread above it. And I can do that by buying that spread. Typically, I like to keep these equal width. So I would be spending a little bit of money here, about $300, to buy a 20-point spread in there. And if we take a look at what this does for a profit curve, wow, that is crazy. I somehow messed this up, didn't I? Oh, it's because it's 3 and 3. That is a wild risk to return, is it not? So profit and loss there, the max loss is 345, max profit 5670. And what I'm going to do is reduce these numbers. Those did not mean to be a single spread. Typically a honey trap is one bear spread that is equal width to the 3 credit spreads that I'm selling. And in this case, what happens is I have a potential profit of $400 above, as long as the trade, this SPX trades above the long put. This will expire for the this will expire for the credit collected. So in this case, this trade could be opened for a credit. If we were to hit submit, the amount is $415 credit. And so that gives me a really nice return on capital, and it brings that break even right around where I expect it to be, around that 6,800 level. It's a pretty solid setup. Now, if I wanted it to be right under that level, all I have to do, and this is one of the things I love about Moomoo, is I can just drag this over. I'm just going to drag both of these over one strike. This is going to decrease the amount of money that I'm collecting. I'm collecting $365 instead of that $415. This type of trade has a massive probability of profit, has an 83% probability of profit, and it has a massive profit tent inside of where I think it may fall. Now, one of the things I can do is I can actually widen this out and collect a little less credit for it. If we were looking at it from a return on risk standpoint, collecting $375 is a massive amount of money. Let's just grab my calculator here for a second, and we'll take a look at how much that is. The max loss in this trade is 36.45, and where's my calculator? There it is. Bring the calculator up here. We've got, if I was to able to open this for 375, which I may not be able to, divide that by the total return, which is, or the total risk, which is $3,625. And this is going to show you that this is 10% return on capital, risk capital in, is this just 3 days? This is October 31st. Wild. It's really, really wild for these types of trades. In this type, what I could do is I could actually do 2 bear spreads. This would reduce my credit, and in this case, it's actually making it small. It's making that credit smaller, and it's making it a negative debit. So if the market goes up, I make nothing, which is not that great, especially if I'm expecting the market to go up. It's creating my profit tent below, and this may be one way where a trader might want to set this up, basically getting into a trade that has very, very little potential on the upside or very low cost to enter, and has a massive potential up to $4,000 with a max loss of $2,000 if a trader was thinking that the stock may drop down into this level between 67.91 and 68.40. And now if we were to mark that on the chart, let's just put that in. Let's put these lines in here. We'll horizontal line 67.91 is going to be right here. And we're right at the top of the candle, and that's what we wanted, right? That's the gap fill. And the other portion of the trade is, so I have to go back to the options chain here just to see that. Basically, there's super little cost, but 68.39 is the other portion of that. So if we go to the chart, we're going to mark another line on here at 68.39, and that is going to be 68.39. Now I'm looking at the left-hand side. When I'm doing this, I'm looking here. That's what I'm looking for. That's the max profit zone. If we were to see a retracement on Friday, that's where it falls. So pretty awesome little setup. I could do a horizontal line there, or is there a vertical line? Maybe I put one of those in, and not that one. Let's do. Maybe I have to do a vertical line segment. Okay, so that would be that line right there. That's that profit zone. That's how I would do it. Those are the types of setups that I might use. The other way we can do it is to reduce this back to a single spread and just change the width of this spread. So we could just move this over slightly. This will also change the height of the trap. This one has a max loss of 3,200 and a max profit of 2,750, still 83% probability, and still collects $255. So it's a pretty flexible trade to really kind of micromanage where you think it might go, really get into some potential risk reduction on these. Another thing we can do if we wanted to target that is use a diagonal. It's a slightly simpler setup, but they can be extremely lucrative. So typically what I want to do with that is still keep that break even, thinking that it's going to fall into that profit tent, keep that break even around this level, that 67.90 or even slightly lower. This is a pretty good trade. I think what I would do, that's $1.40. It's 140 bucks. I really like to look at these and try to focus on making sure that the max profit and the max loss are very similar. If I can get a 1-to-1 ratio there, then sometimes I don't care about collecting a credit. And it's as simple as just dragging one of these over. In this case, the max profit is greater than the max loss. So it not only does it make money if the stock goes up, I make 145 bucks. My total risk on this is $2,800.70, and my max profit is potentially $31.30. By making this bear put spread wider, I actually put myself in a very good position to potentially make some money, even if it didn't come down all this way. Say that the market just dropped to 68.50 and it was still outside of this range, the 68.50 being a long put. There could be some substantial credit to close that bear put spread and close this the 2 or 3 bear credit spreads. Nice little setup, making sure that I get a nice credit to enter this too. You can see the price moving around quite a bit on these. Any movement to the downside will increase the amount of money that I can get for this. So I might put in an order for $1.50 on this credit to open, and let's see what happens with something like that. As always, if I really like a trade setup, I am going to do a little screen grab of what we're looking at there. That's a nice little setup for a potential gap fill trade. Justin saying FOMC's tomorrow. Yeah, FOMC means heightened volatility tomorrow, but we're also going to see potential non-movement. Or if the rates drop, if they cut rates at all, is this market just going to explode to the upside? We have no idea. Like it could really go, and we're already seeing that. Milan saying, hi Levi, this is Milan after a long time. Happy to be here. Good to see you. Awesome. Jim says, hello. Dennis says SOC. Yeah, let's take a look at SOC. I love it when you guys throw tickers out at me. So Sable Offshore, I have been playing this. If we look at the valuation, pretty interesting analysts. This is a strong buy. Not a huge amount of analysts covering this, but the consensus rating right now is that everybody thinks that this is a buy. Currently at $12.58, minimum price target is 28, average price target is 28, 38, and the max is 47. Stock's trading at 12.57. We have to take that with a grain of salt. The stock price has come down quite a bit from its previous highs. So, is there an opportunity to buy? Potentially. We did see this stock trade around $10.30 prior to 2023. So we've seen lots of action over the last 2 years, but we have to go back to this pricing and say, okay, well, there is potential here that we could go back to these levels pretty easily. But when we're at 12.58, it's so close. So the one thing, and I love that you brought this up, thanks Dennis. One thing that I love about SOC is how much premium there is in these are vertical spreads, but if we were to let's just do custom here. If we were to just look at the weekly positions and say how much money is there, you can get $80 for selling the 1250 put. This is the at the money put. This is a crazy return. So if I could actually collect $1 credit, the total max loss on this trade is $1,150. So this is like an 8% return in a week for November 7th for selling the at the money position. So if I was to collect $100 divided by a total risk of $1,150, then we're going to see 8.6% return on capital. Now, I don't necessarily love to do that right out of the gate. That may not be the smart thing to do. One setup that I like on stocks that are kind of beaten down is to just do a ratio spread. I can get $55 for this. And similarly to what I was just showing you, I can actually buy a little bear spread in here. So if I did this, I'm getting a credit of 50 cents, which is again, a 5% return on capital. The max loss right now on this trade, this basic ratio spread of 1 to 2 is $1,100 total. Max profit is now 100, but the credit collected is $50. So it's a 5% return on capital with the potential of making 9% return. And if we look at the curve, we're going to see what does that look like? The stock is trading at 1250. I have been having a bit of a hard time with some of these charts, and just kind of how I have my screen set up or the way my mouse works. So bear with me for a second. I'm trying to get it into a position where we can see it and look at it. Okay, it has a small profit tent there. Another way to do this is to potentially go even lower and sell more of these. So I could do like the 1150 or the 11 put, for example. This one's going to be a debit to open, but I can sell multiples of these. I can sell 3. What if I did like a 1 to 4? This is giving me only a 10-cent credit. I do have to get an initial credit that's big enough to open. So in this case, that didn't make much sense to go to the 11 put. One way to change this is to buy a lower put if I wanted a bigger safety in place. The 1 to 4 on this, if we look at the potential return, again, trying to zoom in here for you, stock's trading at $12.60. If it dropped under $12, the profit 10 actually gets greater. The break even on this trade is $10.48. So depending on how much money we have to throw at it, this might be a really great type of trade. Max loss is $3,145. Max profit is $155, which may be on the low side, but from a 5% return on, sorry, not 5%, $55 return, if we were to clear this all off, $55 divided by 3145, we are getting a 1.7 return on capital, if on risk capital, if the market goes up or SOC goes up in any way. And this is in a very short time frame. This is in 10 days. So annualized, those returns are massive. I want to go back to SPY quickly, because one of the things that another gap fill idea that I like is, instead of doing this type of setup, let's clear this off completely. Let's look at just doing a similar time frame. Say I thought it was going to go down to 6,800. That was where I thought that the stock might go. I can actually purchase a diagonal here. I can go to November 4th and I can buy like the 60, I'll buy below the 67.80 type thing. What I'm doing, what I'm looking for is I want to pay less for the contracts than the amount collected from selling the contract. So in this case, if I'm collecting 6,800 strike on October 31st is collecting $12.40, I would want to try to buy for less than $12.40. This is a $50 wide spread. So this is actually pretty wide. This curve may not be very good, but what this does is it gives me a nice big profit tent. And these are slightly dynamic when we do it as a diagonal. This has a higher probability of profit actually than the honey trap that I showed you. The max profit is not so kind of static, but if the IV expands, this profit tent can actually get bigger. So I'm just going to reset this, and we're going to look at where the break even is right now. The break even is 67.59. And on this trade, it only starts off as a credit of $50. But the cool thing about it is that if the market doesn't drop, this short put is going to expire worthless. And I still have a couple days left in my long put. So if I was looking for a type of position that could handle a drawdown, had no upside risk, it's no upside risk when these are open for a credit. They do have a bigger max loss, but they also have a big max profit and a higher probability of making money. So these are the types of trades that I might look at for that gap fill. 67.59 is the current break even. So let's go back to that chart and zoom in here and look at where that is. Remember, this is for this coming Friday. So 67.59 is... So that particular trade is filling almost both of those gaps. Now, if there is some IV expansion that occurs, if the VIX goes up, this will, in all likelihood, this break even will actually move down a little bit. It only is trading right now, if we look at that, 67.59 is only 20 points above the top of this candle, which is 66.39. Almost, unless we have like a massive craziness that happens, that is a very likely expansion. So this ratio spread, this diagonal spread actually puts you in a position where you're filling both gaps. So a little more risk in play, but a nice little position. Now, can you do it with two spikes? You actually can, right? If you want to, you could do two of the November 4th trades, which would make it obviously very bearish in this case, because you have two long puts and only a single short put. So this becomes a very bearish trade. We're opening that for a debit. There's upside risk on that trade, but I might consider adding a second strike, and we do this one. This one would be for a debit, but we would be able to do this above this price. So say I was to sell this, 60, where are we trading? We're at 69. So I'm looking at like the 68.30. Sorry, I'm looking at the wrong date. I'm trying to get to October 31st. 68.30, $17. Sell that. This is giving me a really interesting profit curve. If the market goes up as we expect it to, This is open for a credit of $600. So there's very little upside risk. The break evens at 67.81 on this trade, and we would have two trades that kind of expand in terms of margin. Now the max loss is considerably bigger. This is one thing to consider here. So, but setting these up as ratios can work extremely well. And this is 3 trades, just so we're clear. Not showing everything here. There's three components to this. On the 31st, that we're selling the 6830 and also selling the 6800, and then on November 4th buying the 6750. Now the interesting thing here is if I wanted to reduce the risk, and I could reduce this initial credit by it's currently $600. All I have to do is just buy a higher strike here. So I can go up and say, okay, well, what can I still get a credit for the 6780? I can't. But that would reduce the max loss and increase the max profit when we're playing with diagonals. This has positive theta decay and considerable, $500 a day, but it's open for a small debit. That's not what I want in these setups. So I would have to drop this down again and say, where can I get a small credit to open? This one only collects $40 to open it. I have a max loss of 8,000. I have a max profit of 4,300, and it's long vega. It's long vega right here, which means volatility expansion helps this trade. It gets wider. So these are other considerations. And again, this is determined by account size. So what you want to do, the delta on this is actually positive. So you have to be a little bit careful. If this trade, if the market was to turn down tomorrow on FMOC, becomes a loser because of the delta. If you want to be absolutely flat, you have to buy positions that are high enough. So you could buy like the 6,800. This would actually cost you $700. And if there's no IV expansion, there's upside risk of 69.56. If SPX goes up, you're into a position where you may not be able to sell off the lower positions. But looking at this, you've got a 59% probability of profit, max profit 4,900, max loss 4,200. So depending on what your current delta is in your position, in your portfolio, this is a very delta neutral trade, looking at slightly negative and has this nice positive vega of 200. So if there was a volatility event, the market sold down, this would expand nicely, which should be a winner. The risk is to the upside when you have short delta. So maybe your portfolio already has long delta and you're looking for some way to hedge against it. These types of considerations could be excellent. And the IV, when you're looking at like Moo, this IV expansion is not, you have to take it with a grain of salt. It's not like, oh, picture perfect, this is what's going to happen. But what we can look at is where the current break even is, 67.44. Unlikely that it would stay at that level. If there was a drawdown, it would actually move over to the left when we're playing a diagonal like this. But costing $700 to open this, and there's a potential that it could go up enough. Like the market goes up, and you're like, I actually can't sell off these puts, and I'm out $700. This is why this portion is so critical to open these for close to either a small debit or a credit. And you can get a credit. Like this is like $100 risk to the upside. So changing that risk to reward much increases the probability of profit, 79%, because the credit or the debit is now so low, paying only $43. And the likelihood is that even if the market goes shooting way, way, way up, these November 4th contracts will still have some value. You can probably make your $43 back, but there is upside risk if the market was to go up above 7,000 in the next couple of days. Who knows? Like this is it could easily. We're calling for the 7,000 level. We're at 6,900 today. That's long-winded, I'm sure, but that's what I'm looking at. Justin saying, on the SPX trade, would you widen and increase the number of contracts? We're talking about that honey trap that I had set up, the 3-to-1. Typically, a honey trap is 3 bull spreads and 1 bear spread. They're slightly offset from one another to build that profit tent, looking for a return on capital that is decent enough. So if you can get, like on the upside, if you can get 10% of risk, then that's a good risk to reward. So if you go up, if the market goes up, make 10%. If of risk, 10% of risk. If the market goes down, you're moving into a position where hopefully you're making up to 100% of risk. That's like the ideal setup. You can kind of adjust it from there, but that's the general setup: is equal width, 3 on the downside, bullish, and 1 bear debit spread against it. And if you don't quite understand what I just described, just when this video finishes, just go back and rewatch what I set up. What I did was I widened up the upper bear spread and did the 1 bear spread slightly wider to really increase the height of the profit tent. Mike Mueller says, Fank says, how do you think the market will react after the Fed meeting tomorrow? You know what? The IV is going to be high for sure. We really just don't know. Powell, like if they, it's so hard to say. Like, what is the expectation? I think that the interest rates are going to drop. We did the Canadian ones come out today? No, they come out tomorrow. And I obviously haven't looked at it yet, but tomorrow we have an announcement in Canada. We're expecting a rate reduction in Canada as well. We only do ours quarterly, so it's a little bit different than the Americans who do it every month. My expectation is we're going to have reduced rates going forward. This is causing the acceleration of the U.S. market going up. U.S. dollars going down though, which is a bit sucky. So that's something to consider. For Americans, it doesn't really matter, but for international traders, those are considerations we have to take into we have to think about it, at least think about it. Mike says, I appreciate the gap fill. You're very welcome. Options. I simply open an at the money put vertical expiring in 2 weeks. I like yours better. Yeah. I mean, this is like, it's 6 of one, half of the other. When we have low volatility like this, there's lots of potential to set up those trades. And I like to think about it as like an iron condor type setup. That honey trap is a form of iron condor. It's like a broken wing. So you can do it with single contracts. Sometimes it's better from a decay perspective to do that ratio 3 to 1. And my patrons know I do tons of ratio spreads. I really like that kind of setup where I have a bit of a component where I can make some money to the downside to build that profit spike to the downside, and then allowing just no risk for the upside. So it's like if this market goes crazy and the SPX goes over 7,000, then I've made some money, which is fantastic. Jim says, howdy. Always appreciate you being here, Jim. Easy Money says, good morning, Levi. Sorry, a little late this morning. Do you like calendar spreads and how do you set them up? I think we just kind of went over that in the diagonals. I don't play a ton of calendar spreads. When in my spreadsheets, when we talk about calendar spread, I'll show you the difference. I'm going to jump into it. Let's just delete this off here. If I was going to set up something, say we'll just do another one on SPX. Say I go to the table and I want something for next week, which is 10 days away, November 7th. And I'm looking at where I think the price may go. I think that the price may go to 6,800. A typical calendar spread is when the strike is the same strike. So when the reason I use SPX is because there's expirations every day. So if I'm selling a 10-day, I typically look to double for the long. So in this case, that would be 20 days out. So I have a 10 days to expiration I'm selling, 20 days to expiration I'm buying. Now, a calendar spread is very simple. We are buying and selling the same strike. So there's no determination. In this case, the price is 1650. If we were to look at this curve, it's great. It's a great profit curve. The maximum amount of money I can lose is $1,700. The thing I don't love about these is that they're quite directional. In this case, if I was setting up this calendar, I really need the price to go to 6,800. And there's no kind of bias one way or the other. So what I do is I typically turn it into what I call a diagonal spread and not a calendar. And that's when the strikes are not the same. So I'm going to pay less for the long position, which therefore tips the risk. If we look at this trade right now, the max profit is where I think the trade might be, 6,800. And I have risk to the downside of 2,000 and I have risk to the upside of slightly less than that, 1,500, but relatively equal. The delta is very neutral. The theta is positive 79 and has positive vega. So I do like these trades. It's a nice little setup. But if the market runs up, I could lose everything that I paid for on this trade. And if I'm opening for a debit of 1750, may not be a great idea. So all I do is change this into a diagonal, and I just increase the width of this spread. So instead of buying the 6,800, I buy like the 6,700. And what that does is it tips my position. The delta is now positive, which means I have less upside risk. I still have a decent max profit of 3,700. My probability of profit, has it actually increased or decreased? Let's just change that back. Let's look at the probability of profit for a second. So probability of profit is very, very similar, 45%, but I have way less upside risk. So say we look at this and the market goes on November 7th, it's trading at expiration P&L. If it's hard to kind of see that there. Oh, there it is. There's the price, 7,000. So if we're trading rate at 7,000, this trade would lose $979 in theory. If I change this to a 6760, that probability of profit hasn't really changed. And now if it went to 7,000, the trade would only lose $408. So considerably less upside risk on a trade like this. And again, this is dependent on what we pay for these. On any sort of spread, ideal situation is that I get a credit to open it. If I can get a credit or a very, very small debit, then this reduces that risk to the upside very little. We can, in times like this, put on a spread above as well. So this is where double diagonals come in. And I think that double diagonals are a very, very smart trade. So we're going to go to the November 7th. And this is kind of how I would modify this. And I would say, well, what if the market went up to 7,000? There's a really good chance that we could do that. If I went to those November 20th positions, the November 17th position, and I would go above and I would buy a trade here as well. And again, I'm using this, it's a little bit of a throwaway, but now I'm getting into a trade that has a slightly short delta actually. So this is now become a short delta trade. We've widened out where that break even is. If it was trading at $7,000 next week, this trade would actually be a $2,000 return. So, but there's risk. You know, this has got $8,000 worth of upside risk. So if the market exploded to the upside, you would actually be losing on a trade like this. And again, that's where we adjust our width. This is 100 points wide. So we don't have to be that aggressive. We could go 70-40. And this is where double diagonals are very, very flexible in what we think may happen. So break even at 70.47, and we can adjust these too. We could say, okay, well, what if we want this at 70.20? Or we can turn this into a calendar, do a calendar above and a diagonal below. That'll give us very little upside risk. These trades are quite nice. The problem with this is that max loss on the downside is a little bit bigger. Huge probability of profit, positive theta decay, very much positive vega. So if there was a downside move, that tent would start to grow. And again, this is unrealistic. We have to take this with a grain of salt, this expansion. But typically, if you're playing for one move or the other, you want to look at a double diagonal. And what we don't want is a saddle to be too shallow. So that's this position in here. This is called the saddle on a double diagonal. We don't want there to be a big dip. You know, what I wouldn't want is it to look like that, which is pretty easy to do. So be aware. These cannot handle volatility events very well. So these types of setups look great. People try to play these on earnings. They do not work very well. This may be the case with FMOC tomorrow, just so you know. You know, lots of potential profit, but if there's a big move, we could see volatility drop in the back month, which is the 20 days to expiration, November 17th. We're definitely going to see a front month drop tomorrow on these trades. Hopefully that helps a little bit. The honey trap, really, there's less volatility in there, but that is a very nice trade because it's very easy to track. So for beginner investors, if you're not used to playing diagonals, then that honey trap setup, the broken wing iron condor, works very, very well. Gail had a message for Attractive. But NVIDIA, are you touching that one? Not really. You know, NVIDIA is kind of like a crazy time. Let's look at the chart on NVIDIA, and then where are we here? NVIDIA. Look at that. You know what's interesting? I love Bollinger Band setups off the VWAP. It's like one of my favorite types of just from a visual perspective, like what is happening, where are things going? We're actually inside of the range, which is wild on NVIDIA. The I don't think we're at a very good market value though. So if we look at NVIDIA fair market value, that's I'm obviously not logged in. Let me just give me 1 second to I've lost my access. I'm gonna have to figure out what I don't know why I don't have my plan on there. Oh, sorry about that, but that is not working very well. So yeah, I can't see my fair market value. I got to get that sorted today. I haven't used it yet today. So I was putting on a bunch of trades, but I wasn't actually looking at that particular thing. So I am currently not playing it, but there's lots of opportunity in it. If we were to look at NVIDIA, I mean, obviously you want to avoid earnings and things like that. But if you go to NVIDIA stock, similarly, I would be looking at either honey traps, or I would be looking at playing, you know, those diagonals and saying, well, what happens if this stock comes back down? So trading at 191, there's lots of premium in here. You can get 1% of the strike, the strike. This is one of the kind of my rules of thumb is I'm looking for the strike that has closest to 1%, and that's this one. So 172 strike collects $188. The 170 collects less than 1%. So this is the one that I would be looking at. From a put selling perspective, a lot of people just look at that and they go, okay, there's earnings November 19th. I maybe not do that on the 21st. So let's do it for the expiration prior and say, what can I get? And again, scrolling down and see 180 is equal to 240. No, that's the wrong one. 182 equals 92. And then the 180, 156. So 182.50 is where I would look to sell. And then if I wanted it to be a downside protection, what I could do, and in this case, 17 days, I would go out to a diagonal and say, okay, buy double that. And if I'm collecting 194, I can buy the 170 for 194. I get 2-cent debit. And then if I look at this curve, I have the potential of making expiration P&L of about $217. If it retracts, I've got a break even of 179. No real upside potential on that. And this is part of why I'm not trading these types of things. If I wanted a position on NVIDIA, another way to do it is to just say, okay, what if I was selling that short call and then make it into a ratio spread? So say I want that 17 days, which is pre-earnings, November 14th expiration. And if I look at that and say, can I buy a little spread here? Absolutely. You know, we can buy a spread above it just to help with that profit tent, and then do this as a ratio. So sell one more of these lower puts at the 182. This gives it's a 1-1-2 trade. You know, you can lose your shirt on something like this. Collecting $320. The max loss is 35,000. If you're really worried about it, just buy something crazy down here. You know, just buy like the 160. Then you've spent a little bit of your money. You're still collecting 283, but you've bought yourself a hedge. Now the max loss is only 19,000. The credit collected is way more than 1% of that. It's just the curve isn't that great. You know, you end up with a kind of a deep drawdown if it was to drop between 160 and 179. But you've got a break even at 179. You have a nice little profit tent, max profit of 531. From a return on capital standpoint, pretty awesome for a high probability trade. And if you really wanted to take all of the risk off, then this is where you get into just buying a second 160 put. This will give us a defined risk trade, expiration P&L, max loss of 4,000, max profit of 493. So making a over 10% return if it falls into the tent, and opening this up for $2.44. So from a calculated return on capital, $244 divided by the total risk, which is we'll call it $4,010 with some commission. So we're looking at 6% return on capital in 17 days with a nice potential boost of up to $500. which would be awesome, you know, like making somewhere between a 6 and a 15% return as long as Nvidia stays above 180. Stock did move at $8 today. So it moves around a ton. It can blow through this really, really quickly. I don't love it from a chart perspective. Not typically when I would be putting on a trade like this when we've got, you know, a strong candle to the upside. But if it follows this trend, it could easily continue up. So I hope that answers your question. I know that I get into these. I know that this is like I fly through it and it's complex. I just want you guys to be aware that there's many ways to skin a cat. You know, we can look at how much the credit is collected. That is super important. How much is that credit or debit paid, or the profit that is likely, a likely profit? How does that relate to the risk that we're taking? How does all of that fit with our account? That's another consideration. So something to consider always is like, is this putting my account, you know, at risk? Like if I have on that trade, if we look at that, that's like a short delta trade. And if I have a long stock portfolio, the delta on this is 22. So it's positive delta. If I have a long stock portfolio that is already heavy with QQQ, if QQQ drops and then and Nvidia is a component of that, both of those trades are dropping. That may not be the best setup. So what I want to do is I want to balance that out, and we can do that by using options. That's what their choices. So those are my considerations. How much is this trade making? What's the total risk? What's the return on risk? But then also, how does it fit within the components? What else I have on? What else are we talking about? Mike says, have you ever been in a trade where you got a great news pop? I was in Qualcomm Leaps yesterday and cashed in a nice winner. Yes, I mean, I have and I haven't. You get, you know, I think that kind of happens all the time. One of the setups that I like to do is if I am selling something, like let's just say, I wanted to build something on something that I thought was going to break out. Let's go back to SOC for a second. Let's just look at SOC. And Sable Offshores, they've been beaten down where we know they're at like a valuation where they could easily go back up to $30 a share. So if I wanted to trade options on this, how would I set something up that I have the potential of making money, but I can actually make money from theta decay. So I have positive theta decay, positive potential to the upside. And I did this with a very similar trade to this on oil just recently, and it's been a nice win. And I did one on Shopify that I closed for 50% return. If you guys didn't check that out in the Discord, I mean, that Shopify trade was relatively small. It was a $6,000 trade. It's very similar to what I'm about to show you. It made $3,000 profit in a month. It made over, what was the total return? I think it made $113 a day for 27 days straight. And that was just based on a momentum to one side. So it was absolute winner pre-earnings. It wasn't even an earnings play. It was just like, let's see if the stock is going to run up. So we're looking for opportunity and saying, okay, let's get directional and something that can make a ton of money. And if you set them up right, you can actually make money and in a slight downturn, which is wild. So let's go out. These don't have to be crazy. Let's go to like December and we'll just buy some, say like 14 calls here. And I'm going to buy, the secret with this is buying more than I'm selling. And in this case, what I'm doing is I'm selling a short duration 12 call, which is close to at the money. If the stock drops, these are going to expire worthless and I'll have collected all the credit. The total amount of money that I've spent on this is 325. So let's look at the curve. What does this look like? It's pretty good. You know, you have a total max loss of 325. You have unlimited max potential. There's a little bit of red here, which I don't love. So, and this is where you just get to tweak your trade. And it's nice when you trade stocks that are pretty liquid. But here's a good example. This is a $475 trade showing that the amount may be $385. So you've got a total max loss of 385. You have unlimited profit, 79% probability of making money. Positive theta decay, it's pretty small. Slightly positive vega, But the delta is 44. If this stock goes up, every dollar that goes up, this trade makes 44 cents. 79% probability of profit. If it expires here, if we just look at this over the next 10 days, this trade, did I just adjust that? Is that what happened? 475, something jumping around. That trade is going to make, $45 here at this strike. So $45. Well, that is a 10% return on risk capital. If I can get into this for $440 and it makes $45 in 10 days, it's awesome. I have potential. These are the types of trades I want to be in when there's news. Break even's 1150. So again, going back to that chart, we can just pull this up and say, okay, well, where is that? Where's that horizontal line at 1150? It's down here. I mean, the stock has to drop still even further from where it is. So I'm basically saying I am profitable almost everywhere that this stock has traded. That is how I like to play my options. So limited amount of risk, pretty easy to manage. If they do go down, then the short calls expire. They're making positive theta decay. I'm getting paid to hold a position, and I can make $45 if it doesn't move, and if it goes up, I can make money. Unlimited amount of money, which is awesome. The other thing you can do with these is you can sell a call. You can do them all covered. You just do 2 of them in the money, and then you do 1 out of the money. So if we went to November 7th, which is where the other contract is, we got 2 of those at the 12. You can just sell a like 16. That'll give you a little bit smaller debit to open, and reduces your downside risk, changes the probability of profit, changes the curve, adds some upside risk. Probably not a good idea for 10 cents. I wouldn't be doing that kind of thing. I would just delete that off and just play this there if I wanted a big upside potential in a trade like Sable offshore, if that makes sense. It's amazing how my internal clock just like hits. We're at that point in the stream where I'm like, whew, okay, am I hungry? Am I thirsty? What are we doing? We've got a couple more questions and we're going to cut it. So thank you guys so much for joining me today. Terry Mahoney, good turnout, great advice. Thanks. As always, thank you, Terry. I appreciate it. But as always, not financial advice in any way, shape, or form. I have to say that because I'm not doing it. I'm not an advisor. I chose to take this route, which is totally different than what people do. I want to help people. I want them to be encouraged to say there's choices, there's ways to make money that are different than going to a bank and paying an advisor. I could have gone down that route easily. I could have sat in an office and said, yeah, let's make $500,000 a year just selling people products that are probably not that good for them. But instead, I choose to sit there in front of you guys and do content on my own, which is a way different career path. But it is a way that I hope I can reach more people and actually make people more money in the long term. That's the goal, is that everybody gets rich together. So appreciate it. Justin's asking, so what is your favorite trade strategy? Now, that is a very good question. If you were to look at my rolling options record keeper, one of the things that I wanted to do when COVID hit, I was at home. I was recently retired from my career, and I was like, I need to look at how to make money off options and how to do this. Prior to that time, I had basically been a put seller. I was like, I was selling puts, that was it. I sold occasional covered calls. It's a great strategy. Short puts are still one of the most lucrative strategies. And if I only had to pick one strategy, if I had to pick one, there was only one strategy to trade, I would say that it absolutely has to be covered calls. Now, it's not even short puts. If you had asked me 10 years ago, I would have said short puts, but now I say covered calls. The reason for that is because covered calls can be done in any account. There's a finite amount of risk. There's a definitive return on risk, and all trades are based off of a covered call strategy. What happens if I own the stock? I own the stock in a quality company. I'm not going to play bad companies. I'm only going to play ones that I want to hold, and I'm going to sell covered calls against it. Now, I trade covered calls frequently. I trade them in the money, so they're a synthetic short put, but that is the trade that I would take if there was one trade to take. Is that the trade that's going to make you the most money? Absolutely not, because the return on risk is small. Even when we play trades, like when we play them pretty aggressively on a weekly basis, you're typically making like a 1% to 5% return on risk capital. if you're playing relatively close to at the money for weekly trades, which is still good. It's still like a 500% annualized return, but there's tons of downside risks. You have to be prepared for that and you have to be okay with it. I like ratio spreads, the similar to like that honey trap, things like that. Those trades are so smart. They have a defined risk. They have a nice profit tent. They have, you know, no risk to one side. So they're directional, they're positive theta. They have a limited vega exposure because even if the volatility expands, the risk is defined. And those trades like a honey trap can be very, very good. But this becomes situational. If the volatility was high, I would trade more honey traps or more spreads because the premium is bigger. When the volatility is low, like it is now, is relatively low, diagonals and calendars make more sense. So that becomes the basis. My rolling options record keeper just combines all of those things. It takes all of those trades and says, there is not a trade that I couldn't take. I can pull up any single stock in any single position and put on a trade. I can say, what if I want to play a scorpion? What if I want to play a humpback? Rampart. We designed trades for every single situation. And that's one of the things that's super flexible. And it's what I do in my Discord chat is allow people to learn a whole bunch of different scenarios. The trade that I did a ton of this week, I think I put on like 10 of them already this morning, was a 3-to-1 put ratio spread. So I'm doing a bear spread with 3 short puts because I don't think we're going to have a massive drop in some of these companies that I was doing this in. I'm looking at the fair market value. I'm doing some calculations and saying, where do I think this is going to be? I'm building a profit tent below where we are, and I'm looking to collect, 1% a week on those, and I'm happy with that rolling forward. So this week or today, I would say my favorite trade is like a 1-to-3 ratio spread. So selling 3 short puts, buying 1 long one below the money, but very close to at the money. Okay. Gail says, yes, that's great. You're welcome. Mateic says, thanks. Mike says, Levi has a lot of energy. And Justin says, thanks. I agree. Defined risk, less buying power. Those are the ones that pay the most. Okay, you guys are awesome. I appreciate it so much. Thank you so much. If you're not in the Discord chat, head over there. You can get through it through my Patreon page. You can go and join for free. And then there's a link to the Discord over there. So you can sign up and you can see those things. And the goal here, of course, is let's get rich together. Thank you so much, everybody. Take care. I'll see my patrons on Thursday for the members only live stream. Bye now.